Ray Dalio is an extremely successful and well-known investor. He also produces lots of great YouTube videos where he talks about the global economy and also how he thinks you should be investing. Now, usually I just take it as thought-provoking and interesting, but he has said some things recently which I think could seriously damage your wealth. So I think I'd like to talk about that in this video. If you do want to keep abreast of what's going on in the economy and also learn more about investment, remember you can always sign up to our free weekly market roundup. There'll be a link above me and in the description below me. So to look at what Ray Dalio has got wrong, let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. So this is the really problematic quote above me from Ray Dalio, where he says most people think that cash is safe. Cash is the least safe investment. I think that is completely misleading. And even though he comes to that conclusion based on a lot of historical evidence, I think his reasoning is flawed. And in this video, we'll see why. Now, of course, the return that you get from investing in something really safe like cash is going to be low over the long term. So in almost all situations, cash will underperform bonds, which in turn will underperform shares. I don't think that's contentious. There's a huge amount of historical evidence to show that that's true. And I certainly agree with some of Dalio's conclusions, in particular that you should diversify your portfolio. And the reason for that is that the outperforming countries and sectors from the previous decade will not necessarily outperform in the following decade. So in the last decade, it was US tech, but it may not be US tech which continues to outperform in the decade ahead. But I do strongly disagree with the statement that you should ditch cash altogether, particularly if you do want somewhere temporarily to put your capital where it will be safe. I also disagree with his statements that bonds no longer are a good hedge for equity. I just fail to see what the alternatives are, even though yields are very low. If you do look at the correlations between equity and bonds, you just see that they are negatively correlated, or the correlation is close to zero, which is exactly what you want from a hedge. Also, even though you're not paid much, it's a hedge you're paid to hold, which is very valuable as an investor. But I do agree with Ray Dalio that gold is looking slightly attractive at the moment because real interest rates are low and the dollar is weak. And those are usually fundamental reasons why gold rallies. And there is a bit of a disconnect. If you build a really simple explanatory model based on just three factors, which is US inflation, the strength of the trade-weighted dollar, and also real interest rates, you can see that that tracks the price of gold fairly well over the last 16 years or so. But the interesting bit of the graph is just here beside me, where you can see the price of gold has recently fallen quite a bit, whereas the fair price model is actually going up in value. That's because real interest rates have fallen again, and we've also seen the trade-weighted dollar weaken, both of which tend to push up the fair value of the price of gold. And if you are part of our Patreon community, then you get access to that model. There's a spreadsheet which gives you the latest value for the fair price of gold and silver. And if you're not a member, it's really easy to sign up. There should be a link above me. Another place where I think Dalio's reasoning has gone a bit wonky is to do with the dollar as the global reserve currency. And you've probably seen this graph somewhere on the internet in your Twitter feed. This is showing what happened to reserve currencies over time since 1450, although I'd question whether that was really a reserve currency as we think of it in those days. So what this is really about is which is the dominant economy globally, because usually the currency goes hand in hand with that usually military supremacy. And as we go from the Middle Ages, we shift from Portugal to Spain to the Netherlands to France to Britain, and then finally to the USA. And the point is that each of those regimes lasts about 100 years, which means that currently we should be coming to the end of the US's tenure as the reserve currency. So this is the value of the trade-weighted dollar. This is the strength of the dollar versus a weighted basket of its trading partners. And you can see that recently it certainly has weakened slightly, but it's certainly not disastrous if you compare it with what happened in the mid-80s, for example, or in the early 2000s. And what's quite noticeable is that when things get really scary, as they did during the global financial crisis, the dollar strengthens. It's still seen as a safe haven, and we saw that again when it spiked in value in March when equities were selling off. It's still seen as a safe store of value. And in fact, one of the reasons why it's weakened has been that risk appetite has actually improved because equities have rallied a lot and the dollar has weakened as vaccines have come online and the vaccination program has started globally. But all you have to do is look at the share of the dollar as a reserve currency compared to other currencies to see that it's by far and away still the dominant currency. It still makes up more than 60% of foreign exchange reserves. So here's other data, in this case from the ECB's annual report, which is called the international role of the euro. And here is the foreign exchange part, and you can see the dollar is more than 60%. The second largest holding of reserves is in the euro, and other currencies don't even get a look in. And that pattern of dominance is mirrored if you look at international debt. The US is by far the most commonly used currency if you want to raise capital, with the euro at a fairly distant second place, and the Chinese renminbi is hardly visible on the graph. The same's true for international loans, and if we look at foreign exchange turnover, again the dollar is the dominant party, with the euro second. And if we look back to 2006, the US dollar was then about 68% of foreign currency reserves, so it's only really fallen by about 8% over that 14-year period. Now, when a country invoices another country when it sells something as part of its export business, then the question is, what currency are they going to use? Here's a lovely graph from an IMF report, which is broken down by currency and by region. And it's not very surprising that in the euro area, it's primarily invoiced in euros. That was one of the reasons why the euro was created. Whereas in Japan, it's about 50-50. About 50% of the invoicing is done in yen, which is the orange part here. A tiny fraction is in euros and about half is in the US dollar. Whereas in Latin America, the dollar is by far the most dominant currency. The same is true in Sub-Saharan Africa, Central Asia, East and Southeast Asia, and in the Pacific region. So will the US dollar always be the reserve currency of the world? Of course not. There will be another currency that comes along, but it's going to be some time before that happens. It's still by far the most dominant currency, both in terms of foreign exchange reserves, also if you want to raise capital, and also if you want to invoice a foreign country for your exports. But the point where I disagree most strongly is that I believe that cash is safe. What I'm tracking here is the value of $1 invested in one of 5 ETFs at the beginning of 2020. You can see what happened in March, which is that the risky assets, which are the 3 which you can see just above me here, are the ones which fell severely in value, but then consequently rallied. So that this line here is US equity, it's the SPDR S&P 500 tracker, but even if you'd have invested in something like emerging market sovereign bonds, which is lending to sovereign governments in China, or Mexico, for example, either in US dollars or in their local currency, those also sold off quite severely and have also rallied. But the 2 assets which actually kept their value or actually rallied strongly are either cash, which hardly did anything because that's what cash does. And here as a proxy for cash, I've used US short-term treasuries as tracked by the iShares 1 to 3 year Treasury bond ETF. And was it safe? Yes, of course it was safe. It kept its value. It hardly changed in value at all. It did rally slightly, but it certainly didn't sell off. And if we look at US long-term treasuries, those are up over 20% by the time we get to April. And although their value is now falling slightly as people pile back into risk assets, you can see that that also has been a safe store of value. And it acted as a very effective hedge when equity markets sold off. So government bonds, even though the coupon that they pay is very low, have been a very effective hedge in 2020. Whereas other assets, which some people have suggested as alternatives for developed market government bonds, have acted as a very poor equity hedge. And that would include emerging market local currency bonds, hard currency bonds, or even other equity, which is supposedly high quality. Now, of course, if we look long term, investing in those safe assets would be a very poor strategy. If we repeat that exercise and invest $1 in 2004, then it's absolutely no surprise that the S&P 500 tracker would be the one which gave us the greatest return. You'd have more than tripled your money over that period of time. Long duration treasuries would have almost doubled your money, but if you'd have invested in very safe short duration US treasuries, your value would have only gone up by about 5% over that 16-year period of time. And we should always consider real returns. In other words, once we've adjusted for the value of inflation, because the whole point of investing is to increase the amount of goods and services that we can buy. And now you can see the erosion of value over time that you get with the 1 to 3 year treasury bonds. The income and the capital gain which they've generated has been less than inflation fairly steadily over that long period of time. And the reason is that over that 17-year period, the cost of living has gone up by 40% in the United States, as measured by CPI inflation. Long duration treasuries, because they tend to give you a higher income with a greater volatility, of course, because of the duration, have managed to beat inflation over that period of time. But if you really want inflation busting returns, you have to go for equity. Not necessarily US equity, but maybe something like a global equity fund. So if you are going to park money in safe assets, such as short duration government bonds or cash, don't do it for very long, because inflation will almost certainly erode the buying power of your capital. But if we look at that US inflation rate over a period since before 1900, this is over a century's worth of data, I've marked on with the dashed red line the US central bank's average target for inflation, which is 2%. And you can see that for about a 30-year period, they've done a pretty good job of keeping to that 2% target. And furthermore, the current rate of inflation is only 1.2%. So I really wouldn't believe all these overblown claims that we're suddenly going to get hyperinflation. Keep your eye on the actual data and you'll see that that's far from the case at the moment. And if we look at inflation in the UK, the pattern is very similar. We still see a very subdued rate of inflation, even if we include something like owner-occupiers housing costs, which is the subcomponent which is growing most. If we exclude owner-occupiers housing costs, the rate of inflation in the UK, the most recent one, was only 0.7%. So the rate at which your cash is being eroded is absolutely tiny at the moment, over a period of say 1 year. To put that 1.2% loss in value into some kind of context, if we compare it with the typical one-day move in the equity market, that's usually around 1.3% for the S&P 500. So in other words, the amount of money that your cash loses in inflation over a period of 1 year is about a one-day move in the equity market. So if you do invest in equity, you'd hardly even blink at that loss. Or to put it another way, is cash a safe store of value even though it's losing 1.2% in a year? Yes, it is. The other argument which Dalio has been using for a long time now is that money printing necessarily creates huge inflation. There's a really nice paper which they've come up with recently at Bridgewater, which is Dalio's investment shop, called Grappling with the New Reality of Zero Bond Yields Virtually Everywhere. And I did a whole video for Patreon members where I went through this point by point, saying which bits I agree with and which points I think are just wrong. But they identify 3 stages of monetary policy, which they call MP1, MP2 and MP3. MP1 was when we just had central banks that set interest rates. When there was a crisis, they lowered interest rates and that induced spending. And if inflation was too high, they raised interest rates and that cooled off inflation. At least that was the theory. MP2 happened after the financial crisis when the central banks started buying US treasuries. And the idea there is that the money that was released when the central bank bought those treasuries would then be used by people and also companies to buy assets such as equities, but also to spend some of that money. What we've seen in 2020 is a very clear coordination between the government, in other words, fiscal policy, where the government spends more, but also the central bank simultaneously lowering interest rates and monetizing some of the treasuries by buying them. And that has a much more direct effect on spending because literally people get checks in their bank account from the central government and interest rates are lower. So now that we've moved into the MP3 regime, are we seeing hyperinflation? Well, certainly not yet. In fact, I challenge you to see where the point was when quantitative easing started on this graph of inflation. Even though the Fed's balance sheet is now more than $7 trillion, it's very difficult to see any sign that inflation has been severely increased by that move. That's not to say it won't happen, but it certainly hasn't happened yet. And potentially one reason for that is that the velocity of money, which is how often a dollar is used over some period of time, that's collapsed since this crisis. In order to get inflation, when you print money, it has to be spent. Whereas the trend that we've seen since before 2000 is a steady decline of the velocity of money. Now, we've seen the household savings rate increase significantly through this crisis, presumably because people are worried about the job situation, but also because they can't go out and spend the money. So if confidence does return, potentially there could be a spike in inflation driven by the ability to spend the money and also having the saved money for some households. But it remains the case that unemployment is generally high, both in the US and in Europe and elsewhere. And in that kind of situation, people don't have the confidence to go out and splurge their money. That's the kind of environment in which we get precautionary savings. So the key thing to watch here is what happens to employment. If that does start to recover very well, then that could be a prelude to higher inflation. But I think a key bit of economic history which is really worth looking at is to do with Mr. Burns. Oh, sorry, it's not that Mr. Burns. It's Arthur Burns. He was the Fed chair between 1970 and 1978, and he was put in that position by Richard Nixon. Now, William Safire has written a book called Before the Fall, and he was someone who worked in the White House under Nixon. Now, the central bank is supposed to be independent. They shouldn't be affected by political pressure. They should always do what's right economically and not what's politically expedient. Now, because Nixon wanted to be re-elected in 1972, he put pressure on Burns to reduce interest rates. And that would have increased employment, and he was hoping to ride that wave of good economic news into his second term as president, which in fact he did. But the way he ensured that Burns did reduce interest rates was to release negative press stories about him in the newspapers. And he also floated threats to dilute the Federal Reserve's independence. In other words, he threatened the Fed. And unfortunately, Burns did cave into that pressure. And what happened is a salutary tale in why central bank independence is a good idea. So I've got three graphs here. One of them is CPI inflation in the United States year on year. The second graph is that federal funds rate, which is set by the central bank in the US. And the third graph is the price of oil in dollars per barrel. There were a succession of economic crises in the early 70s. And in August 1971, Nixon announced that the dollar-gold convertibility was going to break. It was no longer the case that every dollar was backed by a certain amount of gold. And in order to stave off inflation, Nixon also imposed price controls. And in order to supposedly protect American jobs, he imposed a 10% tariff on all imports. Now that was of course inflationary. And as we can see here, he also successfully put pressure on the Fed to reduce interest rates. Now that was seen as a success, and in the 1972 election, Nixon won a landslide victory. But following that victory, look what happened to inflation. It rose above 10%. It's almost unimaginable now to have inflation at such high rates. And at the same time, there was an almost perfect storm as the price of oil tripled between 1973 and 1974. And that increased transportation costs to move goods across the United States, for example. And then we had the Watergate scandal, and in August 1974, Nixon had to resign. Now in 2021, it's very likely that we'll have this combination of Jerome Powell at the Fed and Janet Yellen as Secretary of the Treasury. Now both of them are fully committed to having an independent central bank. Now if we do see average inflation increase much above that 2% limit, and remember, it's undershot for some time now, so we'll be allowed to run a little bit hot, but the Fed will certainly act to stave off very significant inflation. And it's very unlikely that this Fed chair will cave in to political pressure. So I think a very significant increase in the rate of inflation is unlikely in the near future, particularly with this combination of Biden as president and these two running the economy. So let's end by coming back to this question of which assets are safe. Are there any alternatives to government bonds or cash? And we can go through some of the suggested alternatives from Bridgewater in that paper that I discussed earlier. One of them is simply to buy government bonds from regions where rates are high, and that would usually be emerging markets such as China. But there's no way that sovereign bonds in China have the same political stability or the same liquidity, that's the ease of buying and selling, that you get for US Treasuries or other developed market government bonds. Plus you have that EM currency risk. Another suggestion is that you buy bond-like equities. You look for companies which have very strong balance sheets, which are very stable, and which have low volatility. But even low volatility equity stocks are still very high volatility when you compare them with, say, intermediate term government bonds. Plus, at the first sign of trouble, the first thing that a board does at a company is to cut the dividends in order to shore up its balance sheet. So the dividends you get with equity are nowhere near as safe as the coupons you get with government bonds. So very risky bond-like equities are simply a very poor substitute for government bonds. And then finally, gold also has a high volatility, and it also has its own crashes. Sometimes it crashes when equity markets don't. And in particular, if real interest rates show any sign of increasing, gold usually sells off. So I don't think gold is a good alternative to much safer assets such as US Treasuries. So with all due respect to Ray Dalio, I think he's wrong. I think cash is safe as long as you don't park your money there for long, because there you do get the effect of inflation eating away at your capital. Now, if you enjoy these videos and you want to support us, then you can always join our Patreon community. And in order to do that, you'll see a link beside me, which you can click on to learn more. And there'll also be a link in the description beneath me. And as always, thank you for listening.